first of all,
Yeah.
the 14.4
Yes.
starts at the depths of the last recession. Is that correct? That's where you measure it from.
Well, we have to differentiate between the two asset classes, really, real estate and the stock market. Of course, they work sort of together, but we need to, they operate a little different at both ends of the extreme, at the lows and the highs. So, taking the lows, the stock market recovers first, which it did. We had the lows in the stock market. The Nasdaq bottomed in October 2008. The Dow bottomed in March of 2009. I'm not measuring the 14 up, 4 down from there. We've got to talk about then real estate comes in. Real estate's the last to recover. US real estate, pretty much, figures I've seen roughly, and of course, United States is 52 states. It's states, right? It is a combination of states. I'm talking homogeneously the whole United States. You can't talk about that picture really. Every state's a little bit different. The real estate lows were around about 2012. I just add 14 years up from there as a general framework. Individual states can differ a little bit, and of course regions and towns and localities. I don't get into the fine print. We're just doing the framework. So 2012 plus 14 gives you 2026. I know some people are going to have trouble with that. It's too simple. But if you look at the history, this is what the history demonstrates. So we've got a few years left up yet.
Right, and then what you also talk about is these mid-cycle downturns, right? And that's not a real estate downturn, is it? So is that what we're hitting right now? And is that naturally triggered by this black swan event of COVID-19, or is there something else going on, do you think?
All right, now there's two things in that. The mid-cycle is usually just stock market driven. After 7 years going up and 7 years bull market, it's just time for a pause. It doesn't usually involve real estate or land values, and that's because interest rates are usually lowered fairly quickly. The second thing is on that, you mentioned what they call a black swan event. That's named, of course, for the black swans that turned up in Perth in Australia when the settlers discovered there was such a thing as a black swan. I don't think there are black swans in economics. I say that for the very simple premise that after 7 years of asset price rises and credit creation, it just so happens that if you get an event that sort of tends to come out of the blue, because we've had so much credit, it's just that the economy is on a weaker footing. If this same event had happened at the lows, it's probably not seen as so dramatic, and it's not going to turn the economy like it normally would. So I'm not a believer in black swan events. It was just time. It was time for some sort of event to take place that would turn the crowd from greed to fear. And if you have a look mid-cycle, you'll see there are always events that take place mid-cycle. You can go back to the year 2000, 2001, where you'd had a huge boom take place before that. And of course, you got the events of 9/11 that turned greed to fear. If you go back to 1981, into 1982, it was very high interest rates. And then you got Paul Volcker at the Fed having to introduce some dramatic strategies that again turned greed to fear. Adam, I can tell you, and Steve as well, this is a very regular pattern. You can see this, it goes back to 1800 in the United States. I'm staggered that other people don't see this. It really does.